10-step plan to fixing poor credit and raising your credit score fast. Presented to you by Stacy Williams from Resourceful Capital Financial Corporation. First, you must understand that your credit score is just a numerical expression based on a statistical analysis of your credit files. Credit scores range between 300 to 900. The higher your score is, the more creditworthy you are and the lower interest you will pay on any kind of loan, from credit cards to your mortgage. And as you can see, it's very important to have good credit score. So let's get started in improving your credit score. The simple truth is, it isn't as hard as it may seem to increasing your credit score. It's just knowing what to do and understanding the factors that affect credit and what the agencies weigh, and then figuring out which of them you can change for the better. Over the last few years, we have helped thousands of people fixing their credit scores, and based on those experiences, we have developed a 10-step action plan to getting your score up quickly and keeping it there. Our promise to you, regardless of where you are starting from, if you follow this plan in a few short months, your score will be higher than you ever thought possible. Get your free credit report and check it for errors. In Canada, there are two credit reporting agencies. One is Equifax, the other, TransUnion. 80% of Canadian lenders use the Equifax Credit Report, and the remaining use TransUnion. Due to federal law, Canadians are allowed to use Equifax and TransUnion for a free credit report. Once you get free credit report, you should go through your report with a fine-tooth comb, as it's reported that almost 75% of all credit reports contain some sort of incorrect information. If you find any damaging errors, for example, late payments that were actually paid on time, or credit limits that are lower than they should be, or incorrect accounts, it is very important to get them corrected as quickly as possible. You can do this by sending the credit reporting agency a certified letter that explains what information was inaccurate, including copies of documents such as bank records or mortgage statements that verify what you're saying to be true, along with a copy of your credit report with the disputed information circled and marked in red. Under federal law, both the credit reporting agencies and the banks and merchants that provide them with data are required to correct inaccurate or incomplete information in your report when it's pointed out to them. Rarely, errors can help you, as when accounts you closed are listed as being open. Don't feel obligated to correct these. Automate your bill paying so you never miss a deadline. Even if it's only a few days late, just one overdue payment, whether it's for your mortgage, your utility bill, or your auto lease, or even a Visa or MasterCard account, or any other credit obligation, it can seriously damage your credit score. Equifax pays a lot of attention whether you make a habit of missing due dates, so a series of late payments can actually hurt your score. By the same token, a consistent record of on-time paying can improve it. Although Equifax says it takes as much as 2 years of on-time payments to increase your credit score, our experience is that when you pay all of your bills on time for the next 6 months, your score will improve. This is why it's so important to set up an online automatic bill payment plan with your bank. Don't panic or despair if you have missed payments. It's never too late to fix your credit. Get yourself current as quickly as you can, and then stay current. Your score will begin to improve, and the longer you keep it up, the more noticeable the increase will be. The negative weight your Equifax report gives to bad behavior like delinquencies lessens over time. So as long as you stay on the straight and narrow path, those black marks will eventually disappear from your record forever. Use your credit lightly by keeping your balance well below your credit limit. Of all the factors you can control and improve quickly, how much you owe to an individual creditor is probably the most simplest yet most powerful. It's highly recommended that you should never have more than 30% of the credit limit as your balance, as having a high balance will lower your credit score. Spread your balances around, and don't borrow from one lender to pay another. Using one credit line to completely pay off another sets off alarm bells at Equifax, even if you're doing is consolidating your accounts. All other things being equal, your credit score will be higher if you have a bunch of small balances on a number of different credit cards rather than a big balance on just one or two. So spread your debt. If you rack up high balances, pay your credit card bill early. The amounts owed part of your Equifax credit report is based on the balance due listed on your most recent credit card statements. So even if you pay your bills in full each month, running up high balances can still hurt your score. You can avoid this problem by paying down all or part of your bill before the end of your statement period, thus reducing the balance due that will be reported to Equifax. Hang on to your old credit accounts, even if you're not using them. Closing old accounts shortens your credit history and reduces your total available credit, neither of which is good for your credit score. If you have to close an account, close a relatively new one and keep the older ones open. It's also important to note that closing an account will not remove a bad payment record from your report. Closed accounts are listed right along with active ones. Use your old credit accounts. In the last few years, creditors have begun a custom of closing inactive accounts. This can hurt your credit score, since it reduces the average age of your current credit accounts. So, our suggestion is that you pull out your old cards and use them once in a while. This will keep the account open, which in turn will keep your credit history nice and long, and ultimately raise your score. Demonstrate that you can be fiscally responsible. The best way to raise your score is to demonstrate that you can handle credit responsibly, which means not borrowing too much and paying back what you do borrow on time. Don't open new accounts just to increase your available credit or create a better variety of credit. This is especially true if you are just beginning to establish a credit history. Adding a lot of new accounts may look risky, and it will definitely lower the average age of your accounts, which can hurt your score if you don't have much of a track record. You should open a new credit account only if and when you need them. When you're shopping for a mortgage, use a mortgage broker. When you apply for a mortgage or loan, the lender will pull your credit report from their system. That is, send an inquiry to one of the credit rating agencies to find out how creditworthy you are. Too many such inquiries can hurt your credit score, since that could indicate you're trying to borrow money from many different sources. But when you use a mortgage broker, the mortgage broker will pull your credit bureau only once and share the same bureau with many lenders. So there will only be one inquiry and your credit will look nice and clean. If you follow these simple steps, your credit will begin to improve in as little as 30 days, and you'll be on the road to having excellent credit. Visit rc-financial.com or mortgage-rates.ca for more helpful hints.